I'll go ahead and get us started. Welcome to today's Winning on Wednesday webinar, Roadmap to Succession Planning, this time from a financial perspective. My name is Kristen, and I'm the Digital Marketing Specialist for Wegner CPAs. Today's session is being recorded and will be emailed to you after the event. It will also be available on our Wegner CPAs website under the recorded events section. If you have any questions for our presenter today, you can put those in the Q&A box down at the bottom of your screen. We'll try to get to all of those either during the presentation or after, but if we don't, just have them in that box and our presenter can follow up with you after the session. Our speaker today is Nathan Brinkman. He is the owner and founder at Triumph Wealth Management. Nathan, I'll turn things over to you.
Well, good afternoon, everyone, and I hope you feel like you're winning on this Wednesday. It's certainly nice to have a little moisture in the air given the dryness that we've had so far this spring, but it's hard to believe here in a few short days we're going to be entering into Memorial Day weekend. So wishing you and yours a great day and looking forward to sliding into a elongated weekend coming in. So joining me as well is Susan Thompson with Action Coach, and obviously Dan Berg, one of the managers at Wegner. And part of our ideal here is to put together some resources and topics for you to discuss as owners or people that support owners in the idea of succession and transition planning. So today, I'll spend a little bit of time focusing on the financial elements of things. So as we jump into this, a lot of people, I think we're in a very great area in the country, the Midwest. We're known for our, if you've ever seen Charlie Barron's, we're overly nice. And part of that, I think, is we all live and support our communities. So just to introduce a little bit of me, I've come from family businesses. This is my family. I tell everybody that my wife, my kids get their good looks from me just because my wife still has hers. I've been doing this for 25 years, and our focus and niche around here is we just help and support people that own and run companies in this intersection of transition and succession. So it's where I spend all of my time. From there, we've developed a substantial wealth management firm, investment planning, and risk protection as well. But again, my days are largely spent working and planning through succession and transition issues. So why is that a big deal? Well, if you're familiar with where we are as a country, it's been labeled the silver tsunami. In other words, this concentration of folks, we'll call them 50 or over, that are entering into this retirement timing phase. And we look at the preparation that they've done to date, and it's a little scary. And part of that is our job, we think, is to create awareness. And you may be thinking to yourself, well, I've got everything covered. Well, let's walk through this and just make sure that we've checked all those boxes, and maybe we can provide a third-party perspective of really where you truly are. So here's some interesting numbers. 41% of owners say they have a documented plan. They've actually thought about it, they've written it down, they've had said plan. That doesn't mean they've actually communicated it, but it is somewhere in writing. 60% of owners do not have a buy-sell agreement. This is the legal document that's put in place that outlines how the structure of a deal would go. Again, there's a buy side and a sell side, so it's actually done. So again, 60% of owners do not have that document. But we do know this: 100% of owners will exit their business. Obviously, the easy way out, one of the guarantees, is death, and obviously we just got done paying taxes, so those are fresh on our mind. But the whole deal is those that put this off, that have a lot of excuses that we come up with, really this isn't a maybe, this is a must do. So we all have these excuses, if you will, these thoughts that cross our minds, whether they come overtly or maybe they're floating around in the back of your mind. I'm not going to read all of these, but a lot of what we hear is, boy, if I'm working on my business, particularly in the last 12 to 18 months, I kind of feel like I'm always in crisis mood or trying to address the daily needs of the business. How do I even think about taking time to address some of these issues? Sometimes it's a money issue. Sometimes it's even going through, I don't know if I'm ready, or I don't know if my business is ready, or I don't have anybody I can even think of in terms of transitioning to. So these are all important issues that should be addressed. If you can't come up with a solution on your own, this is a good place to employ others around you, advisors or other resources to help you walk through or talk through that process just to get further down the road from starting from nowhere. What are the other headwinds that face us? Well, we know that studies have come back, particularly this is from the Family Business Alliance. The failure rate in transition planning is high. In other words, going from generation 1 to generation 2, only 30% of them make it. You go into the third generation, 12, and by the time you get to fourth generation, I mean, you are talking the unicorns, 3% of business. There are 3% of businesses make it to the fourth generation. So in our state, luckily, we actually have a high concentration of fourth generation businesses. I can think of a couple of third generation businesses off the top of my head here in Dane County. So we come from a robust area, and maybe this seems like, well, yeah, we know a few people, but literally these are diamond in the rough or unicorn type businesses. So why do businesses not transfer to the fourth generation successfully? Why is this such a low percentage? Because it's hard, it's tough. And if you don't invest in the planning process, the failure rate obviously is very, very high. So why do second generations fail? We'll just go back to that particular number. Well, it's basically because after the planning has begun, the process has begun, few actually finish the steps and see it through. In other words, half of them have roughly half have identified steps. They've calculated the needs. They know what it takes to get it done. They 22% hire a successor. Only 25% or 25% actually get a value of it. And then very few, under 20%, actually create a written plan. So with most of our clients, this asset is a large portion of their overall net worth. The business represents a tremendous portion of their overall net worth. I went through that 6 weeks ago when we talked about why we do what we do. But having that written plan is really, really important, and understanding the value of that plan is even more important. We'll talk about that in a few minutes. But basically, the definition, some people say, well, what is succession plan? The definition is to have a process of developing a written plan for the day a business owner decides or is forced to step down from their leadership or ownership role in a business due to voluntary or an involuntary departure. So there you have it, folks. I actually own a dictionary, and this is what it says. But at the end of the day, it really is, I want to stress this, having a written plan, having something that it's forced you to think through this and to commit it to writing, and then more importantly, share it with those around you. So what are the good parts of an appropriate succession plan? Well, you should have your goals in there. You should have your successors outlined. Again, those may or may not need to be updated depending on management changes, leadership changes, whether or not families float in and out of the business, who ultimately is the ownership, and that may change today. Again, management, transfer, and what are the finances? In other words, there's a cost to doing business to this. If you want to successfully transfer or succeed your business, it's not free. And it's definitely not cheap. So it is a definite investment you want to put into your global business plan, and you want to allocate resources, most importantly, time, to take care of really mapping yourself through this process and identifying what is a good succession plan. It's documented, and even more important than beyond the documentation, including these 6 important elements, it's got to get communicated. Without communication, we often see this where families or even managers, there's a lot of infighting because they're like, well, he told me or she told me I was the one that was going to be charged, or I was going to have ownership. And without that communication, obviously, creates a lot of infighting in the end, which is what we're trying to avoid. Oftentimes there are folks that ask me, well, what do we want to do? Well, there are some golden rules in succession and transfer planning. One is to know your options. And their ramifications, the good, bad, and the ugly. So if you're looking for kind of like, well, how do I even embark on this journey? Well, one is to explore and educate yourself on what those options are. 2 is get your business valuation taken care of. You got to understand what the value of your business is going to be. We've talked about this in the past, but I can't emphasize this enough. The value of your business will change based on what your true exit strategy or plan will be. So just because somebody throws out a value, and we'll talk about this in a minute, doesn't mean that that's actually what it's worth. I'm not going to go through all the stories, but long story short, where we sit today in this housing and real estate market uh, is definitely a value today. It may be very different 2 years from today, and it was different 2 years ago from today. So it is a space and time, but you have to really look at what is it that you're shooting for in terms of when you evaluate your company. Select and train your successor and communicate it to everyone. This is an intersection where a lot of people get stuck, right? We feel like we're playing favorites. Really what this does is it provides that format. You want to know today is your successor respected? Can they lead and manage their peers? Are they a true leader? Are they worthy of replacing you? If you get a lot of feedback, they may tell you early on in the process that you may or may not have the appropriate successor, or you have to invest in that person to train and develop them so they are a legitimate leader in terms of what you want to see with the future of your business. Fourth is you put a plan in writing and you properly fund it. So just having a written plan is great. But if there's no way to pay the bills when all the dust settles, well, that too is an issue because you're going to create a lot of stressors on the business and potentially your family. Review your plan every 3 years and make updates to it. Again, something we see often when we ask folks is like, do you have a written plan? Yep. Is it funded? Yep. Well, when's the last time you looked at it? I don't know, 10 years ago. Okay. Has your business changed? Has the value of your business changed? Anything? Oh yeah. Well, it's probably a good idea that the appropriate time frame we see is every 3 to 5 years. This does not mean you have to go engage with your attorney or an accountant or a business valuer or services like Susan and myself. What it means is you want to reread it. I too went through this personally with my estate plan. There are things that 5 years ago I felt very strongly about that I feel very differently today. My kids are older. The people around me have matured and developed, and so I this year had to update my plan. And I think it's really important to do that. I was really surprised. I forgot, frankly, some of the language I had in my succession plan, and I'm glad I changed it because it's more reflective of what I feel today. So if you're looking for, well, what are golden rule number one, know your options. We're just going to do some quick hits here, but basically you have some ways to exit your business. One, commonly people think about is you can go public, right? You can take a private entity and put it out there and go public. Two is you can go through an ESOP, employee stock ownership plan. These are extremely popular right now, and I think likely if there's changes in the tax code, these will likely be a strong contender moving forward. Three is you can gift it to a family member. You can sell it to an outside buyer. Again, think of like private equity or somebody just comes in and writes that big check. We see that often. And I would say kind of in the other bullseye area of what we see happening is an objective to sell to management or an inside buyer, somebody that's worked with or for you for a while that you have great confidence in. Or lastly, you can say, I'm just going to sell and I'm going to get the heck out of this thing and I'm not going to have any headaches moving forward related to the business. So we call that liquidation. Obviously, that provides the least amount of value generally amongst the list. But you got to know your options, and then you have to, from that option, see if there's something that kind of floats up as a favorite, and then test that out to make sure it fits what you're really trying to do. So again, one of the things you should do is just look at what is your liquidation value. So a terrible thing to think about, but I'll use myself as an example. If I was suddenly diagnosed with a terminal illness, and I just had to cash the chips and walk away and enjoy the last moments of my life, what would happen? Well, it's not what we want. There's only 12% say this is their plan, but in reality, this happens 40% of the time. So although this is something you may not think is going to happen, it's the most used option. It's forced. It's not planned for. It's usually this is what happens. We see this happen quite often, actually, when people get deep in retirement. They haven't done a good job of preparing their business for a sale or transaction. And it kind of gets in the end, they're just fatigued. And so they just end up saying, I'll just take whatever's I can see in my yard or inventory or whatever, and I'll just take that and then I'm done. So again, it's not generally a preferred method, but it is the most executed method of exit planning. So valuing your business, you should have it documented. What's kind of fascinating to me is where do people get their values? So 46% of them get them from an accounting firm like Wagner. 31% get from a true business valuation firm. And this is interesting. 1/4 of them just get it from, they value it themselves or their business partner, right? So that is the least reputable way to value your business is you or your business partners or family internally value that, but business owners over under their value by as much as 59%. So the reason we say that that's not a value we normally trust. So again, I'm not trying to be offensive to you personally, but if you do work with advisors like myself and others as they relate to the transition or succession model, we don't believe your number. And the reason is because we know the percentage of error that this could be is very high. And so we'd rather hear it from somebody else outside of you because that gives us that working number. And again, because your business generally is what we see is a high concentration of your net worth. If we're off on that business value, we're going to be off on a lot of the other advice that we give you. So don't take offense to it. I believe it's a worthy investment to go through having your business valued, particularly since it is such a big part of it. I liken it to this is most of us know what the value of our house is because we get sent a form every year that says this is what the city of so-and-so values at, and this is what we're going to tax it at moving forward. They don't do that for your business. So it's good to reach outside of you and your business and have somebody else tell you what it's worth. So again, I think that's a great place to start if you're looking to start from somewhere. Why do you want a valuation? Well, you want it to measure your business health. If you just think about it, if you track and manage the value of your business over a number of years, you're going to see it go up or down depending on what's happening. It's kind of like getting a checkup with your doctor. You'll know the sale value in the marketplace. That's part of what a business valuation process will do is it'll tell you what the market is going to pay out there right now, and it'll prepare your business for sale. Likely what we see is when you get a valuation done, they'll give you some advice kind of as a bonus, an add-on to a valuation report. And they'll kind of tell you where you fit amongst your peers. And they'll tell you maybe some strong areas and some weak spots, blind spots that you may have. That's a great area to focus on. And likely the next time you get your valuation done, if you work on those troubled spots, you'll see the value go up. And then lastly, many people need that number of what their business is worth in order to confidently step forward in retirement. So again, I think it's a great area to start just because you want to value everything around you. So as you're going to do the calculations for what kind of retirement lifestyle am I going to have, that's going to be a really important part. What do you need from a valuation? Well, you need a valuation if you have multiple owners. Again, this could be subject to the angle or lens of which they view it. I always talk about marketing and sales. So if I have an owner that's in marketing and an owner in sales, they both think their divisions are more valuable than the other, right? So you want somebody outside of you and your partner, if you have multiple owners, tell you what this thing is worth, and then appropriately fund those buy-sell agreements. Again, I have partners in one of the businesses that I own as well. I love my partners and they're awesome. And I love their spouses. I just don't want to be in business with them. So I want to have the legal right to buy it out. And even more importantly, I want to make sure we have the financial resources to buy that person out in the event that something happens. And again, we'll talk about that in a second. And then it gets you ready to sell. So it determines things so nobody's arguing about the value or asking about price. We all agree to that. That's a good thing of what a business valuation will do. And then one of the most important things that's going to come up here in the near future is estate taxes. So we know right now they're relatively high. It's been some of the highest estate tax relief that we have, but it's going to change at the end of 2025. So we're right now talking to a lot of our clients, again, thinking 5 years down the road, what is this new estate tax going to look at? It's on autopilot. It's going to revert back to what it was back in 2018. Starting in January of 2026. So we know this is going to happen. It's a good area for us to plan on, but we got to know the values, and then we need some time to make sure if we're going to make changes that we test those changes to make sure they're the right things to do. Oftentimes we talk about select and train your successor. So this is kind of one of those inside jokes. If you have kids in your business, hey, sorry, Dad, my true passion is making furniture, not dams. It's kind of the same thing. It's just done a little differently. That's what we find within different generations. Generally, they have the same purposes. They just look at it or they view it very differently. And that's some of the things that we look at within family business as well. My point here is you want to make sure you train and develop successors, whether family relation or not. Because if you want to walk out the door someday in confidence, you have to have somebody that is respected and that is well infiltrated, if you will, in your organization, your business. That includes your staff, employees, but it also includes any of the other business partners you have out there, clients, vendors of the like, things like this, bankers, so that they're not calling you saying, "Hey, we don't know what's going on with this successor." 1 out of 4 successors is not even aware that they're the chosen one. Again, that goes back to the communication. So oftentimes we call it the wait and see. Well, we're just kind of waiting and see what happens, but we have to communicate that. There's good reasons to do it. One is let them know, because they may say, "You know what, I'm not interested, boss." We've had that happen before. Or they're like, "Man, I'm glad you said something because I've been kind of having an eye at a different job because I feel like I want to move up and I mastered what I'm doing here and I feel like there's a better opportunity outside of this." So again, that communication is really important, identifying them, but also communicating that. So if 25% of them don't know, I just challenge you, does your successor know? 1/3 of business owners are not confident in their chosen successor ability to run the business. So again, this is something that we highly encourage folks to do is put them in training and develop, make sure that they can meet and match expectations. And then half of them are reluctant to pass the baton to the next generation. This is totally natural, normal. Thank goodness here, if you're in Dane County or the Madison area, we do have the Family Business Center that we can lean into. There's a ton of resources available here. We're really, really lucky compared to a lot of other places around the country. So we can help the successor establish the clear guidelines to become a leader. We can develop their future leadership and talent. We get in that development plan, so we want to clearly outline what the expectations are and what we expect them to be. Coordinate the plan with family members and key managers to make sure everybody's buying in here. Establish or encourage mentorship, and then spend time working out of the business, meaning you need to figure out what your what next is, and you need to spend time out of the business, allowing them real life time to either to fly or walk. We'll see what happens. So number 4 is planning in writing and more importantly, funding it. So buy-sell agreement is just this legally binding document that one party sells the other in the event of a triggering event. We'll talk about that here in just a second, but basically you want to make sure you know the amount one owner pays to the other. Oftentimes I see with buy-sell, there's not actually an amount in the document. In fact, I don't normally recommend that. I recommend that we have a way of valuing the business. And so we have to agree on that methodology, create the funding source, and then know what parties are eligible for retirement. So this is going to be important. If you think about this, if somebody goes through a divorce or in the middle of a divorce, but they were in the original document, that's a big deal. And then also, this is really critical, is what is the definition of a disability? I'm not going to go into a lot of detail given the time, but I can tell you that is a major issue with documents and something I would encourage you to do a deeper dive on. No offense, but we know when you're alive or you're not, but disabled is a whole nother key and category. So some of the red flags we see: established incorrectly based on the business entity type. So again, think of you have an LLC and eventually you go to an LLC taxed as an S Corp, or you transfer from a C Corp to an S Corp, or you now are part of a conglomerate. You want to address all of the issues of entity and ownership. Doesn't account for the 5 Ds, which is death, disability, divorce, departure, think retirement, and disqualification. That is another big one. So again, if you're in an industry that requires licensing or registration and you have a partner that does something to lose their license, you want to make sure you have a way to force them out, if you will. And then there's no proper valuation of business. We talked about that before. It's a willy-nilly number, and it's not funded or signed. You'd be shocked at how many documents, oh gosh, we never got around to signing that. Well, they have it. Well, if it's not signed, it's not eligible. Putting the plan in writing, again, we kind of talked a little bit about this, but just having multiple owners agreeing to the price, you want to fund it. Here's an example of a buy-sell. These are normally funded with life insurance. Why are they funded with life insurance? Well, because one of the biggest triggers is death. It's a guarantee versus the other ones. So that's the most likely thing we're going to look to fund, and it's final, right? So there's not a lot of negotiations if one of the owners is gone. So again, review the plan every 3 years. So the last time the document was reviewed 1 to 3 years ago, 44% say they do. Less than a year ago, 24%, and then there's this 21% that basically they have no idea. They barely ever review it. So is your buy-sell funded? 12% say it's not. 44% that it is funded with a cash flow of the business. So again, just think about the strain and the stress that could be left behind in that. 18% they funded it with a disability buyout, and then 35% they funded it with the life insurance side of things. The go-to resource for succession planning, again, review the plan every 3 years. Who should you be involving? Well, obviously a business partner if you have one, your lawyer, your somebody like me, other financial professionals you have in your life, think banker, CPA, and if you have a spouse, you might want to involve your family members that are integral part of the business as well. You know, everybody asks me, well, like, who should I look for? It's somebody that you feel like has your best interest in mind. They're not just doing, you know, product sales. They're actually taking time to meet with you, understand who you are, what you're trying to get done. They understand the needs of business owners. Again, a lot of people providing advice right now have never owned a business. They've never had to meet payroll and go through HR issues and be the IT guy the next second. And then just, you know, look at your long-term relationships. Who do you have in your stratosphere that you trust that maybe has gone through something like this before? And then obviously if they're responsive, that's a big deal in today's world. So again, we've gone through the definition of what a true succession plan is. We've talked a little bit about the funding of that. We've talked about some of the triggering events in the funding. The golden rules, again, just know your exit options. And if you don't know them, lean on resources like Wagner, Action Coach, myself. Get your business evaluated. It's really important to understand, like, what do you have? Not just from your perspective, but a third-party perspective. Select, know, and train your successor, develop them. It takes time. This is not an overnight process. People do not wake up one day with leadership skills. Oftentimes I see that people, because they're so comfortable dealing with the chaos of being a business owner, they just assume everybody else knows. Most of our business owners have forgotten more in the last year than their successors know. Successors need that experience, both successes and failures. Having you side by side with them will save you time and money in the long term. Do not expect perfection, expect progress. Progress over perfection. I can't repeat that enough. So all of us, you know, our favorite person to talk about is ourselves, but you have to involve other people in this process and put it in writing and communicate it. So you're the key integral part of your business, but it's time to invite others into the process, make sure they understand what's going on. A byproduct of this is you will likely have more staff engagement. In other words, when they know what your plan is, it puts them at ease too. Because at the end of the day, senior management and people that are really involved in your business, they want to know that, God forbid, if something ever happened to you, that's it's all tied up and it's taken care of on the backside. And then, of course, review it every 3 years. So with that, see if I can get on the right screen here. Sorry. Let me know if there's any way that I can help you out. Obviously, reach back to Dan via Wagner. And we just want to, again, thank you for taking your time. If you do have questions, obviously you can address them in the chat room. Please keep in mind these are recorded and will be on the Wagner CPA website. Again, we want to be respectful of your time. It is now 12:30, 1/2 hour. We hit it on the button. So again, we appreciate your engagement. We'll look forward to again to seeing you in 3 weeks, where Dan will be presenting once again. And if you do have ideas or suggestions for topics or things you really want to know, that's what we, Susan, Dan, and myself are interested in being a reflective service to that. So please engage with us. Let us know if we're doing a good job. Let us know if there's other topics or issues you'd be interested in. So I will pause. And Kristen, is there any questions that popped up that we can address?
Nope, I don't have any questions here in the Q&A box. but certainly if any questions come up after the presentation, feel free to reach out to any one of us and we'll get those answered for you.
Great. Well, thank you again for joining us on Winning on Wednesdays. We'll look forward to seeing you in 3 weeks. In the meantime, be well.
Thanks, Nathan.